Good evening, everyone. Looks like it is 5:30 Mountain Time, so we're about to get started, but we've got a lot of attendees still joining, so we're going to hold off for another minute or two, and then we'll really start diving in. All right, good evening, everyone. Welcome to our monthly webinar. We've been having some tremendous feedback and plan to keep bringing you this relevant, compact information in this nice little 1-hour webinar each and every month. We'll be covering a variety of topics, and as you see, we bring in some of our friends in the industry to share their expertise. We may or may not record each event, so it's important for you to register and sign in as early as you can so you don't miss anything. We'll also have the opportunity to ask questions live on the webinar, and we'll do our best to answer each and every one of them. I want to say thank you to everyone who made it onto tonight's call. We know that you're giving up some of your time, so Peter and I will do everything we possibly can to bring you the value that you're hoping for. Tonight should be easy as we're talking about a very relevant topic, taxes. Now, my name is Justin Cooper. I am a loan officer, business development over here at Pine Financial Group. Pine Financial Group is a hard money lender. Personally, I am also a real estate investor. I own a couple rental properties. I manage them myself. I've done fix and flips. I've done new construction. I've done direct mail. I've done wholesaling. I've done a little bit of everything. I use my self-directed IRA to invest. I have bought non-performing notes. I wouldn't do or say that I'm an expert in most of those, but I've certainly dabbled in them, and I've done them myself, so I certainly know enough to be dangerous. But the hard money thing is definitely the full-time job. Now, Pine Financial Group is who, of course, hosts these webinars every month. Now, Pine Financial Group is a hard money lender. And what we like to do is cover 100% of your deal. So now, hard money isn't cheap, as I'm sure a lot of you know, and we're not talking about hard money tonight necessarily. If you have any questions about it, of course, I'm happy to chat with you tomorrow via email, on the phone. Feel free to ask some questions here tonight in the question section. We're not using the chat tonight, we're using the questions. But outside of our loan, everything we do, or just about everything we do, is free. And what we try to do is provide a ton of value, such as these monthly webinars. We host monthly networking events in the 2 locations that we operate, Colorado and Minnesota. And we also put together our yearly, or sometimes twice yearly, Real Estate Investor Success Summit. Now, if you're in Denver, we have our next ISS, Investor Success Summit, coming up on Saturday, May 7th. And the Investor Success Summit is a full-day, educational, no sales pitch event where what we do is we'll bring in 8 different speakers, and each one will be speaking for an hour. So how do we do that all in one day? What we do is we have 2 rooms and 2 speakers going at the same time. So you can actually pick and choose which topics you want to hear. We also are ending with a legal panel. One of Peter McFarland's associates will be on the panel in the afternoon. We'll be wrapping up the day around 3 o'clock and having a networking cash bar open. Actually, your first drink ticket comes with the $15 admission to the event. And we're trying something out a little different here. We're bringing in Home Depot for a working lunch. And Home Depot is going to be talking about all the different programs they have that work well and match up really well with real estate investors. So we're trying it out. We're going to see how it goes, but regardless, I think they're going to have a ton of great information. So that being said, tonight's webinar is important because we're talking about taxes. Now, we shouldn't be investing solely for the tax benefits, but there certainly are benefits to be had if you know the rules. It is tax season, and there's no better time to be talking about this than right now. Whether you're pushing to get your taxes filed for April 15th, or you filed an extension, or you're just planning ahead for the future. Now, I feel fortunate to be introducing Peter McFarland tonight. Peter has a wealth of knowledge when it comes to taxes and real estate investing. He's personally put together my estate plan and helped me with restructuring my entities to make sure that I'm well protected. He's also working on my taxes this year, and he has already helped me identify several areas where my previous tax guide left money on the table. Thank you for joining me, Peter. Peter,
Oh, yeah,
there he is.
absolutely. Yeah. Sorry, I muted myself in case, we got some feedback or something. But no, absolutely. My pleasure to join you, Justin. And thank you for all of the incredibly kind words. I have nothing but great things also to say of Justin and Pine Financial. I've been going to their meetings for as long as I've worked at Estelle and Long, years now. And the value that they do provide is really phenomenal. There are a lot of real estate investor groups, but honestly, going to Pine is always kind of the highlight of my month, and I really do enjoy working with you guys. And I've also been to these investor success summits, the ones that Justin was talking about just briefly there, and again, can't recommend that enough. If you've never been, go this year, because really the opportunities, if nothing else, the two stages are great, but even just the networking to see who else is out there, what other people are working on, maybe who they're looking to partner up with. It's really, really unique and really a great opportunity, so you should absolutely take advantage of it. But all that being said, oh, go ahead, Justin.
Oh, I was just going to say thank you for the kind words there. So, Peter, before we get going, tell us a little bit about yourself, and then whenever you're ready, let's dive in.
Yeah, well, let's move on to the next slide, because that's kind of what that's all about.
There you go.
Right? What a great segue. So basically, here's a little bit about me. I am an attorney. This is a picture of when I was much more bright-eyed and bushy-tailed than I am now. That was my very first professional picture. It was taken years ago. I assure you I have some war scars now after dealing with the IRS for a few years. It's time to get a new professional picture, but honestly, just too busy to deal with it. But as you can see kind of from my talking points here, I mean, I'm a Colorado guy through and through. I actually did grow up in Indiana, but was born here, but came back, finished up my law school experience out there at the University of Denver, passed the Colorado bar exam on the first try, a fact that I am still incredibly grateful for. And then my family thought that I was nuts, but I immediately went back to school and actually went to the graduate tax program. Now, that is a special program at the University of Denver that just focuses on the tax code. So I spent an entire year just basically learning to love the Chapter 26 of the U.S. Code and learning the ins and outs. And for a lot of people, that probably sounds like torture, nails on chalkboard. But for me, it was phenomenal because it actually managed to get me my position here as the associate attorney at Estelle & Long. I wear a lot of hats here, as Justin mentioned. I worked on his estate plan, so I do have an estate planning component to my practice. I do deal with real estate issues. I've done a quiet title action, deal with leases, landlord-tenant issues, that kind of stuff. Because of my tax degree, I do deal with tax preparation and dealing with the IRS, audits, collections, all of that. And in this particular context, talking about real estate professional tonight, I actually have litigated several cases in the United States Tax Court, kind of concerning this exact issue and what we need to be thinking about and kind of how it all works with the IRS. So I have a really unique perspective because I actually know what the IRS looks for. And then just a real quick plug of my own, I do monthly webinars as well, and I have an upcoming webinar. It's going to be actually geared just at comprehensive estate plans, and that's going to be the 20th of this month. And one also final last plug is connect with me on LinkedIn. I personally am on there. I go on there every day, kind of around lunchtime to waste a little bit of time and unwind and comment on stuff. So feel free to connect with me. I'd love to connect with everybody on this call. Okay, so for those of you who have been on webinars with me in the past, you know I kind of like to give a roadmap of where we're going to go, what we're going to talk about. This slide will actually show up a few times tonight just to kind of keep us on track, and you can see where I am and kind of where I'm going next. And also, you know, for those of you who have been on webinars with me in the past, you know that I can't help but get on my soapbox a little bit. So from the beginning, let's talk about the opening perspective here, which is, you know, when
Peter,
you... Oh yeah, Justin, what's up?
before we get going too much, did you tell them how they can find out about your webinar coming up? Is there a website or something they
Sure,
go to?
yeah. Yeah, the best thing actually is to connect with me on LinkedIn. You know, we put out the information for how to register on LinkedIn. The firm is also on Twitter and Facebook. You can connect with us on that. We push that information out there as well. Otherwise, you can contact our office, ask to get onto our constant contact kind of email blast, and you know, that's where you get the actual like webinar link to then sign in, much like you had tonight to get onto this webinar. Yeah, thanks, Justin.
Absolutely, thank you.
Yeah, yeah. So, you know, getting back to the opening perspective here, you know, when you get doctors and lawyers into the same room, I think the first question that you have to ask is what could possibly go wrong, and there's probably a lot of answers to that. But, you know, prior to 1986, what went wrong were tax shelters and loopholes. Basically, you had doctors and lawyers making quite a bit of money. They realized that taxes are going to be one of the biggest, you know, expenses that they have during the year. And so they kind of get together, start thinking, well, how could we save some money on taxes? And we wind up getting a lot of tax shelters and loopholes kind of coming out of the woodwork prior to this 1986 revision in the tax code. What they used to do is they would actually generate huge losses, kind of, and even kind of paper losses, losses that weren't really real, just kind of depreciation and things like that, generating these huge losses. And they would offset their regular W-2 income from their practices, right, and save a huge amount of money on taxes. Real estate and investing in real estate, rentals, particularly commercial buildings, that was the most common kind of investment that would produce these losses. And again, a lot of times you would get that through depreciation. So in 1986, Congress totally, you know, recreated the tax code. It's the tax code that we have now. And what they did is actually just slam the door shut on these tax loopholes. The way that the code is written is that real estate and activities in real estate are now a per se passive activity. And so the presumption is that if you're investing in real estate, you know, you're doing this kind of passive activity. When the activity is considered a passive activity, what that means is that all of the income coming off of the activity is going to be kind of categorized as this special type of income called passive activity income. Then any losses that are coming off of these real estate investments are actually going to be considered passive losses. And passive losses, under the way that the code is written now, can only be used to offset passive income. You can't offset your regular kind of W-2 income like you used to be able to. And all I can say is, you know, don't stress about this too much right now, kind of, you know, what I'm saying here, because we're going to explore this more a little bit later. I'm just kind of trying to give you an opening perspective here on why the law is kind of written the way that it is now, right? So what's the value of today's webinar? Why should you stay on the call? I know it's you know, dinner time. Maybe you'd rather go somewhere else and get some dinner. You can get around this kind of passive income issue and the limitation where your passive losses are only able to offset your passive income by electing to be treated as a real estate professional. And I'll walk you through the requirements and how you're actually going to do that. So this sounds pretty good. You know, at a 10,000 foot level, how are you going to qualify for real estate professional status? Basically, you have to jump through 3 flaming hoops, and I call them flaming hoops. We'll talk about that a little bit later. But the bare bones requirements here are going to be that you have to spend more than 1/2 of all of your hours engaged in business activities in real property trades or businesses. The total amount of time during the year that you spend in these activities have to be more than 750 hours. And then if you're looking at taking a loss from any of these properties, you actually have to materially participate in the activity for you to be able to take the loss. So there's kind of three requirements, three flaming hoops that you have to jump through. Don't worry too much again about some of the language here. I mean, we'll talk about material participation. And one kind of wrinkle to keep in mind here, when we're talking about spending more than 1/2 of your hours in the trader business or the 750 hours per year, only one spouse actually needs to meet those time tests. So if you have, I can't be a real estate professional, for instance, because, I have a W-2 job, I'm an attorney, put in some significant hours doing that. So I could never really qualify as a real estate professional, but were I to be married, my wife could satisfy that, and then on our taxes, we could take this stance because she could qualify even though I put in all these hours at my W-2. So that's kind of my opening perspective, just to kind of 10,000 foot show you what we're talking about, where we're going to go. But I talked a lot about passive income and losses, so let's dig into that a little bit more. So basically, I mentioned this, you have income from all of your activities, everything that you're involved in, right? And basically, the tax code is written in such a way that your income is going to be split up into two separate buckets, right? You have normal income, which is like your W-2 wage income, 1099 income if you're a contractor, capital gain if you're in the stock market or maybe selling some investments, maybe dividends, right? It's kind of this like normal income, not really stuff that you're going to see coming off of, like a buy and hold rental kind of scenario. Rental income, on the other hand, as you can see on the right there, it's going to go into a completely separate bucket. You have passive income. So rental income or income from activities in which you don't materially participate, that's going to be passive income. So just right there, the tax code is kind of creating two separate categories of income, right? So we have these two buckets of income, and really what's the point? I mentioned this, and I'm just kind of digging back into this. The point is that any losses that are going to be coming off of those passive activities can only offset that passive income, right? Passive losses can't offset the normal income, the W-2 and all of that. So if we add that into that kind of infographic that I had there, it gets really complicated, and I couldn't help but add a Buddha on there because it just to me looked kind of like a mandala or something like that. But you have your income from your activities, right? And it's going to get put into these two separate buckets. You have your normal income, and then you have your passive income. Then on the bottom, you have any losses from these activities, and the same thing happens. It just gets put into two separate buckets. Losses that are kind of associated with your normal income or the normal activities are going to offset your normal income, and it goes to a certain spot on the 1040, right? Your personal tax return. Then any losses coming off of these passive activities are going to offset your passive income. That also is going to shoot over to your 1040, but it's going to be on a different line. It's going to be on a different schedule. It's kind of treated completely separately, right? So hopefully everybody kind of understands this. I don't think it's too difficult, but maybe the infographic is more complicated than it really needs to be. If there is a question, drop it into the box, and let's go ahead and handle it. And I'm sure Justin will interrupt me or let me know if something comes up here.
Y'all, I'm ready to jump in.
Any questions?
No, not yet. There's some that are floating around, but I think you'll probably cover most of them as we go.
That sounds great. Yeah. Just let me know. So, we're talking primarily about losses here. What if you really don't have losses, right? I mean, your investments are performing well. You have rent coming in. They're cash flowing. Kind of so what, right? What I would do is I'd talk to a tax professional, talk to our office, talk to Stephanie Long here, and look for planning opportunities. It might be time to start putting some money back into the properties and look at maybe increasing your opportunities to depreciate some aspects of the property. The reason I bring up depreciation in particular is because these generally are going to provide these large paper deductions I was talking about, while your property actually still cash flows. So, putting in some kind of improvement that's going to, generate a deduction over several years might help you offset some of the income that's going to come in over, say, the next 5, 7, 15 years, right? So what happens if you have more passive losses than your passive income, right? You have this special bucket with passive income, but you have a huge loss in one year and it's going to be considered this passive loss. Basically, you're just going to carry it forward year after year and it's going to offset the passive income coming in year after year until that the income over the number of years actually eats up that loss, right? If you have an extremely large loss and you just never have enough income that it, eventually offsets, once you dispose of your entire interest, that's actually the language out of the code, once you sell the property, basically, then you can offset the amount of gain that you receive from that property by the amount of that passive loss. So just a quick recap here. We have a special type of income loss called passive income or loss. Passive losses can't be used to offset the normal income unless you sell the property. And there are, two exceptions. The first is real estate professionals. That's what we're going to talk about today. But there's, another exception here, which is for those individuals who don't make more than $100,000. You actually can take $25,000 of passive income to offset normal income. Talk to your tax professional about that. There are phase outs and things like that, but there is kind of another exception in there. But let's talk more specifically about real estate professionals. So the how-to of real estate professional, how do you actually take advantage of this? To be a real estate professional, again, you have to meet two tests. The first is that you have to spend more hours on your real estate activities than you do non-real estate activities. And you have to spend more than 750 hours in these real property trade or businesses, right? I've underlined some special language on this slide, basically material participation and also real property trades or businesses. Let's take a look at what the code actually says about that. So material participation basically comes out of the Code of the federal regulations. It's a temporary reg. We won't get too bogged down in that. But by satisfying any one of these 7 tests, you actually materially participate in the activity. So, you can participate in the activity for more than 750 hours. And when I say participate in the activity, let's take an example of like a rental, right? Basically what we're saying is that you've put in 750 hours in collecting rent, dealing with tenant issues, going over fixing the plumbing, advertising to find a new tenant, any kind of activity here where you're managing that rental. Also, I would say education can count towards that. But anyways, you want to spend more than 750 hours to satisfy that first test of material participation.
Hey, Peter, got a quick question here.
Yeah.
Are we talking more federal code or are we talking state code or both?
Yeah, that's a great question. It's all federal code. This is all IRS, federal government, absolutely.
Okay, very good.
Yeah.
And got a question specifically from a realtor as we're talking about these passive losses and stuff. So the question, as a realtor, can I take the passive losses from my real estate income?
Yes, but we'll get into this a little bit, but you have to group the activities. And if the regulation around grouping is written kind of very vaguely, but you have to group real estate activities in a unit or a group that kind of makes logical sense. So if you can somehow group several different real estate activities, trades, businesses in a way that, kind of logically it makes sense that these activities would be similar and that the losses should kind of be grouped together, then yes, absolutely you can do that. And that's, something, I'm being a little vague here just because, without knowing the specifics, it's a little tough, but that absolutely would be something worth calling a CPA, somebody who really knows these rules and exploring, because yes, there is an opportunity where you could lump all that together and start taking losses to offset that brokerage income.
Gotcha. Thank you. And you bring up a good point because a lot of the stuff that we're going to be talking about, a lot of the questions at least will become very personal, very specific to everyone's unique situation. So please bring all the questions you have, but I think a lot of them, especially if you're referring to your specific situation tonight, it'd probably be best to be reaching out to myself and Peter, and probably more Peter if it's tax related, after the webinar. Send them an email, connect with them on LinkedIn, because a lot of these are going to be too specific, or maybe require follow-up questions to be getting into here in just a short hour of the webinar.
Yeah, that's kind of it. I don't want to burn too much time, going back and forth really. But looking at it generally, yeah, absolutely. That's something, if we can group that correctly, I would say we should do it, and you could see some real benefits from it. So yeah, getting back to material participation here, I'm not sure that I really made it clear, and in a way I'm glad that we stopped for a second so I could back up and kind of clarify this. Of these 7 tests here, it's an or kind of test, right? You only need to satisfy one of these 7 tests in order to be considered materially participating in the activity, right? So it's okay, you want to qualify as a real estate professional, you have to put in 750 hours in real property trades or businesses, but you don't necessarily have to put in 750 hours into one particular rental that you have out of 3, right? You might not satisfy the first kind of test here, participate for more than 750 hours in that one rental, but if you're the only person managing that rental, you might satisfy test 2 here, which is that your participation in the activity is substantially all of the participation by all individuals. That would be easy to satisfy right there because nobody else is even touching the property or doing anything with it, right? Number 3 here, you can participate for more than 100 hours during the tax year, and then that activity is not less than any other individual. I'm not really going to worry so much about number 4 here. An SPA is a significant participation activity. Significant participation activities are more like, practicing law or something like that. It's not something that's really going to apply very much. Once you make this election to be a real estate professional, it actually carries forward year after year, and so you don't have to elect every single year. And so number 5 here, if you have materially participated for 5 out of the past 10 years in the activity, you're kind of just assumed, or there's a presumption there, that you're materially participating in the year that, in the year you're trying to claim it, or the year where the IRS is looking at it, right? That's number 5 there. And then, there's number 6, not really going to worry about. Number 7, it's kind of this catch-all, facts and circumstances. Basically what it means is, looking at the case, looking at your participation in the activity, and looking at the facts and circumstances of what you're doing, that you participated in this activity on a regular, continuous, and substantial basis. And regular, continuous, and substantial is taken directly out of the code and out of case law, out of what the courts are saying. All I can say about this number 7, it sounds really tempting. It sounds like a lot of people would say, oh, well, I don't meet these other 6, but I meet number 7. I'm going to materially participate, no problem. I would say, actually, yeah, you have problems. Out of all of the cases that I've litigated, I have never once been able to get the IRS to concede anything on number 7. And I think that their kind of approach on that is that they're going to throw it in front of a judge and just let the judge decide if under the facts and circumstances it's regular, continuous, and substantial. So you're in for at least a court appearance if you're going to rely on that one. And unfortunately, the legal fees to pay me to do that, or any other attorney to do that, is going to be pretty prohibitive. So I would rely on these other ones, number 2 in particular there, that your participation is substantially all of the participation by all individuals, is not very difficult to meet, I think, if you're the only one doing it, and I would rely more on something like that.
So I got a question here. You say that, one of the spouses may do it, but what if one of the spouses has the W-2, then the other has a real estate license, and on a combined basis, they participate more than 750 hours, but not individually?
Yeah, I would be wary of that scenario. I think You know, the question often becomes, who is the real estate professional? And we can't really combine the two of them, the two of you, as one individual, right? I think one person does need to satisfy these requirements. It's a great question, though.
Gotcha.
Yeah. So I'm going to go back to the slide again. You know, so we talked about to be a real estate professional, you know, you got to meet two tests here. You got to spend more hours on real estate activities in which you materially participate. So we kind of hammered that. You know, there's 7 tests, 7 opportunities for you to show that you materially participate. But there's this other kind of component. You know, you have to spend more than 750 hours providing services in the tax year in real property trades or businesses. So what's a real property trade or business? It's this other list here. You know, it's not just like property management. It's not just fixing and flipping, right? It's a real estate brokerage. It's a lot of different things. I mean, you could be in construction, you could be in development, acquisition, conversion, wholesaling. You know, you could have rentals. And again, you know, we'll talk about this grouping election, but if you can group things correctly, it's really not hard to meet these hour requirements. So this slide, I've already hammered it, but this is just everything on one slide here. And by the way, if anybody would like a copy of these slides, reach out to me afterwards. I'm more than happy to send them on. But to me, this slide would be the one that would be handy to hold on to, because it kind of just lists out, okay, those first 2 flaming hoops, right? What do you need to do to be considered a real estate professional? It's these 2 here, and then just kind of the crib sheet here of how you're going to satisfy that. Okay, so we talked about flaming hoop 1, flaming hoop 2, but we haven't talked very much about flaming hoop number 3. So, you know, looking at this generally, you got to meet that first hoop. You need to spend more than half your time pursuing these real property trades or businesses. Then you got to jump through hoop 2. You spend more than 750 hours pursuing these real property trades or businesses. Then, if you have an activity that's generating a loss, you have to jump through flaming hoop 3, which is make sure that you materially participate in that activity, right? So you could absolutely qualify. The reason that I bring this up, and I don't want to lose anybody here, the reason that I bring this up is that you can absolutely qualify as a real estate professional by jumping through the first 2 hoops, right? You could easily spend more than half your time going through those real property trades or businesses, and then also spending more than 750 hours in pursuing those real property trades or businesses. But if you don't materially participate in any of those activities, you're not going to be able to take those losses and offset your regular W-2 or kind of your normal income, right? So hopefully that makes sense. The tax court and the IRS actually for a long time kind of deflated these hoops into just 2. And there was a line of cases actually coming out of the tax court where we were getting the wrong result, where real estate professionals were not able to take losses that actually they were supposed to be able to take. And the IRS fixed that actually last year by issuing a memorandum basically saying that they're not going to litigate cases, you know, satisfying certain criteria because we were getting the wrong result. So you kind of have to step through this and say, okay, am I a real estate professional, hoop 1 and hoop 2, and then say, okay, you know, I have an activity then that's generating a loss. Did I materially participate? That's hoop 3. So hopefully that makes sense and kind of clarifies everything there. So we talked a little bit about this grouping election. You know, if you have, say, multiple rentals, you actually can group your rentals into one activity. And so that's kind of what this, I like this image here because really I'd like to put all those houses in that, you know, kind of orange-yellow circle there. But if you can properly kind of show that, yeah, you know, all my rental activities, it makes sense to group all those together and it's going to help me meet these hour requirements and the losses all make sense to be grouped, the IRS is going to let you do that, but you actually do need to make this election on your tax return. There's actually 2 separate elections you can make under the regulations. I would work with your tax professional to be sure that you're making the correct election, because there's this 1.4694 where there's actually some traps, but if you do this 1.4699G, that's a little bit better. But rentals is just one way that you can do this. If, again, going back to the person who is the real estate agent, if you can somehow make an argument that logically it makes sense for some of these other activities to be grouped in with your brokerage activity, your agency activity, then you can hopefully convince the IRS, were they to actually look at this, that all those losses should be put together and all the hours should be put together, and then offset some of this other income.
Hey, Peter, real quick, if you have your real estate in an IRA and cannot materially participate, I assume that would exclude from using this strategy?
Yes, that is absolutely correct, and a really good point. That brings up a totally different issue in a way. Yeah, we wouldn't want to use real estate professional, no doubt about that with an IRA. But if you participate kind of too much, and again, that's not the technical legal term, but if you're too active kind of with your investment in the IRA, then you're running into problems with the prohibited transaction rules, and then your IRA, if you engage in a prohibited transaction, your IRA ceases to be an IRA, and then you have to include all of that in your income, and pay taxes, and it can be real disastrous. So investing with your IRA, absolutely a valid way to do this, and a really lucrative way to do this, but at the same time, that's kind of a different avenue. We need to look at prohibited transaction rules, and by all means, yeah, we can't use the real estate professional status. That's a really great question.
Gotcha. So self-directed IRA, say profits and losses, those are totally separate from business income, right?
Yeah, yeah, because it's all going to stay in the IRA, right? The IRA is kind of its own vehicle, and also really its own entity, right? And so all of the tax implications are going to stay in the IRA, and theoretically, assuming you're not taking early distributions or anything like that, are going to be really isolated from you until you're 59 and a half and can begin to take those distributions out, right?
And let's say you are of age, then what happens?
Well, then it's again just kind of a separate entity from you, so the income and losses are all going to stay within that IRA, and then the IRA would make the distributions to you without a penalty or anything like that. So, in a way, the IRA would be like its own investment, and just kind of the performance that the investment does is kind of isolated from you. It just kind of pays, whatever return to you that you decide that you want to take out of that IRA.
Gotcha. Thank you.
Yeah, yeah. And hopefully that answers the question there. IRAs are, there are complicated areas of the tax code, and then there are IRAs, which in my opinion are almost even a whole nother a planet almost in terms of complexity, but again, a real viable way to invest in real estate, and something to look at. But I would keep away from real estate professional with the IRA. We really just wouldn't want to go there. Okay, so we talked a little bit about the how-to of real estate professional. Let's talk a little bit about record keeping and what you may want to be looking at. And why do I keep calling these flaming hoops and maybe not primrose paths? The reason is IRS scrutiny. And as I mentioned, I do this as part of my job here as the Estill & Long Associate Attorney. It's actually how I got my start, because in my opinion, I don't think there's a lot of attorneys out there who actually want to deal with the IRS, and so in a way it kind of made me the no-brainer to hire, right? But basically, the IRS is known to look at these real estate professional cases. The IRS, they can't audit every single return that comes in, right? There's just too many. And so what they do is they identify projects. And at the beginning of the year, IRS attorneys, kind of the big minds at the IRS, they decide what hot button issues they're going to be looking at. And so right now, sole proprietors with a Schedule C loss is a really big one. Real estate professionals is a really big one. Trying to think what else. Schedule E sometimes can. We always hear about home office deductions. They just kind of look for returns with these kind of red hot button issues, and then they kind of poke around and see what they can find, right? In the real estate professional arena, I would say that the biggest concern that I have is, well, number one, logs and books and records, right? You can't create a log 3 years later, produce it for the IRS to look at, and then take it to tax court and expect that that's going to hold up, right? It needs to be a contemporaneous log. As you're going through, keeping track of your hours, write it down as you're, in the year where you're trying to claim this real estate professional status. I was actually litigating a case, it was the end of last year. And basically, my client did a great job actually of keeping logs, contemporaneous logs, but after the fact added in some kind of like estimates as far as how many hours they spent. So what they had was like a date and a description of the activity that they did, but then no annotation as far as how many hours or partial hours that they spent in the activity. And so when they sent me the logs, they had written in, okay, that probably took us about an hour and a half, that probably took us 2 hours, whatever. I actually had an extremely aggressive IRS attorney. He was a young guy. I think he just had something to prove, wanted to work his way up the ranks. But what he told me is that he'd actually send the logbooks to the criminal investigation lab and test the ink and maybe make a fraud referral because the annotations of the hours, clearly had been added after the fact. And if the age of the ink didn't match, then, there'd be a fraud referral. That is extremely aggressive. I can't say that, that's going to happen every time, but keeping good logs, keeping books and records contemporaneous, it's critical. You have to be sure that you're doing this. And the tax court, that's kind of a real famous line in this line of cases, but what they always say is that these logs need to be more than a ballpark guesstimate, right? You can't just kind of write down, that probably took me an hour, hour and a half, something like that. I mean, I would go so far as to give a start and an end time, like 8:47 a.m. to 9:17 a.m. This is what I did. And that's going to look a lot better than some kind of a ballpark guesstimate, right?
So Peter, we live in a very electronic age. People are using spreadsheets, apps, websites, all kinds of different things. How would that work out if there is no ink, if there is no, a physical logbook that someone hand wrote stuff into?
Yeah, it's a great question. And I wish I had a really great answer, to be completely honest. Here's the thing. I've never run into using an Excel spreadsheet or some kind of electronic log in the real estate professional context. So I can't say with 100% certainty really how the IRS would approach that. But what I can say is that I have produced Excel spreadsheets in other audit scenarios, in other tax court litigation scenarios, and the IRS does actually not give much weight to them, primarily because they say, well, I could create a spreadsheet right now that says whatever I want it to say. Right, and the same is technically true of a handwritten log, right? Like I could sit down the night before a meeting with the IRS and write down a handwritten log, but I think that they think people are less likely to do that versus like typing in a bunch of stuff into Excel, right? So if you're going to use Excel, if you're going to use some type of app, something, I think it can be a great tool. But what we would want to do is somehow provide some kind of verification, maybe a date created kind of timestamp or something like that on the file itself. So that way we could, somehow prove, yes, this was contemporaneous. Yes, it was created in 2016, even though now we're, looking at this in 2019, right?
Interesting. So we actually have someone listening in that was a former IRS employee, and they said that what they may do is do a forensic analysis of your computer for that spreadsheet. And
Yeah.
he made a little point that paper is best.
Yeah, and that's actually really good to hear that, and that makes sense. I think doing that forensic analysis would be the exact same as testing the ink in the criminal lab, right?
Yep.
It's just another way to do that.
Yeah. Now, before we get too far ahead here, let's back up on the slide here. And how would we spell the difference between investor hours and real estate professional hours?
Yeah, totally, and that's exactly where I was going next. Perfect segue again, Justin. Yeah, and to the former IRS guy, I hope I'm not leading anybody up a path. I would love to hear your feedback specifically about what I'm talking about here. But anyways, for
He says you're doing great.
Oh, good. I'm really glad. For the investor hours here, basically, it has come up in 2 of the cases that I've litigated. And what happens is I do the initial client intake, and we talk about the hour requirements. We talk about the flaming hoops we're going to have to jump through, right? And I say, okay, look, you're going to have to prove that you had more than 750 hours involved in these activities. And they say, oh yeah, no problem. My logs show that I spent 800 hours, doing whatever, participating in these activities. And I don't have time right at that moment to go through the logs and pick them apart and figure out what's really going to count, what's not. And what will happen is that as we litigate, as we move forward and try to settle the case, then the IRS identifies time spent as an investor versus a real estate professional. And once they take out these investor hours, we've gone from 800 hours down to like 650 hours, and suddenly the person is no longer a real estate professional. So that's kind of the issue that we need to watch out for. And then to answer Justin's question specifically, what are investor hours? It's kind of, if you were invested in the stock market, for instance, rather than real estate, and you were spending time calculating kind of the return on your investment, looking at, the yield, the interest rate percentage, that kind of stuff, those would be like investor hours, right? And so applying it to the real estate context, kind of looking at your spreadsheets, calculating your cash flow, your return on your investment, that kind of stuff, those type of investor hours really are not going to count towards these 750-hour requirements. So what we're really looking for is time spent, like, actively out in the field, working with these real estate investments, being that real estate professional, right? Less time managing your portfolio, more time actively going after these real estate trader businesses. Does that help, Justin?
I think so.
Okay.
I'm sure if there's more questions, they'll just be reaching out to you tomorrow directly.
Right. I can't wait. So, just my quick closing thought here, and I see that actually I'm doing really well on time. I'm surprised. I'm normally so bad at time management. But, just a word on this record keeping. This is my closing thought. I mean, just the last 2 cases that I litigated with this real estate professional status, the outcomes were incredibly different. In the one case, it was the second to last that I did, my client provided me 2 full bank boxes full of contemporaneous documentation. It was extremely detailed. It had an hourly breakdown, just like I was talking about, 9:17 to 10:30. This is what I worked on. And then behind the sheet of paper was like an email and a picture of the property and what they were doing. that type of documentation goes a really long way. And the IRS actually ended up settling that case. We really didn't have to go very far at all. I don't know for sure if that was a decision, because in my opinion, it was really going to be right on the fence. It was one that probably was actually going to have to go to court. And the IRS decided to settle that one. And I don't know if maybe it was because it was right on the fence and the IRS was maybe afraid of getting a little bit of adverse case law out there or something. Or maybe it was just that the guy really didn't want to go through the two boxes. I really don't know. But that type of documentation made my job so much easier and actually ultimately saved on legal fees because, you know, I didn't have to do as much work. You know, the last one that I did, you know, my client provided me with just kind of a flat rate box of documentation. I kind of mentioned, you know, it had a date, it had a description, but it didn't have any indication of how much time was actually spent. That was added after the fact. You know, that type of documentation, first off, you know, we basically had to cave. The IRS really, you know, they took us to town on that one. And you know, not only did that happen, you know, the client wound up owing tax because he couldn't take this real estate professional status. Because I had to put in more work, the legal fees were a heck of a lot higher. And so, you know, a lot of you may not know me, may not have worked with me kind of in a professional context, but I try to be fair with my billing because I know it can be expensive. And, you know, that type of situation, my heart just goes out to my client because not only does he have this tax, but then also this legal fee as well. So, you know, two very different outcomes here. If you're going to try to go for this real estate professional status, I really cannot stress enough the importance of keeping good records and go overboard, right? Err on the side of having more information than less information because it's going to help me, help you, help the IRS get to what really is the fair outcome, you know, if and when they take a look. So with that, I am ready to open it up to questions.
All right. Well, let's stay talking about these investor hours for a second here. So you kind of made it sound like, you know, sitting in front of a computer, you know, analyzing a deal is investing, not real estate professional. What about searching, you know, but if you're in the car driving around at the properties, maybe that is real estate professional. So, you know, what about searching for properties and both sitting on the computer searching for properties and then driving around searching for properties?
Yeah, oh boy. You know, these investor hours, sometimes, in my opinion, sometimes the line between the investor hours and the non-investor hours is actually a very gray line. All I can say is a lot of times it comes down to the individual that you're working with on the other side of the table. And because, you know, the way that the litigation kind of works in America, right, is that most of these cases actually don't go to court, right? We settle out of court. And so if you can, you know, kind of stipulate with the person across the table that, okay, you know, I have to meet 750 hours, 650 hours are most certainly, you know, going to count. You know, we have maybe 100 hours here that may or may not count. And then it kind of becomes a hazards of litigation kind of thing, right? It's like, okay, if we take this in front of the judge and the judge is looking at it and the judge says, well, yeah, 3 hours in front of the computer, and maybe that's not going to count, but being out in the car, that's going to count. You know, the potential to take that to court, to litigate it, may not be worth it to the IRS. And so I'm not really answering your question, Justin, because I think it's a truly gray area where some of this is investor hours and where some of it isn't. And I think ultimately it's going to come down to some of the facts and circumstances, because it may be somewhat unappetizing to the IRS to say that they're going to disallow a certain number of hours because they're investor hours and then take that to court and have the judge disagree. But I would err on the side of to give a quick answer and kind of my knee-jerk answer to what you're saying, Justin, I would err on the side of being in front of the computer probably is not going to count. Being out in the car probably is going to count, but be careful because in this last case that I litigated, the client was taking maybe 8-hour car trips looking at properties and saying that all 8 of those hours should count towards that hour requirement. And I think that's a pretty hard pill to swallow, right?
Yeah.
You may say that you were in the car for 8 hours, but maybe only count 2 or 3 of those hours because of travel time, because of stopping and getting food, gas, whatever, is stopping and smelling the roses, right?
Yeah, so similarly, a lot of people are playing around with out-of-state investing. So what about travel time? Say you live in Denver, but you're investing in Kansas City.
Mhm.
You're not in a car, but you're in a plane, you're traveling. How does all that add up or not add up when it comes to your hours?
Yeah, well, you could count here's the best case scenario. This is what I would love to see if you were a client of mine and we were going to fight this. Is that you come in and you say, I have 900 hours as a real estate investor or a real estate professional, right? Then I begin to pick this apart. And, I realized that maybe, I don't know, 50 of those 900 hours was spent on a plane going back and forth or whatever. What I would do is I would go to the IRS and say, we have 900 hours here. And then, if the IRS says, well, this travel time's really not going to apply, whatever, I say, okay, fine. So then 50 of those hours are gone. We still have 850, right?
Hmm.
What I would try to do is make sure that you have 750 solid real estate professional hours and then continue to log the rest. And then what that basically does is just give me, your attorney, another attorney, whatever, ammunition to go to the IRS and just say, look, these are the hours that we have. We have 900 hours. Then as it begins to get whittled away, which it absolutely will get whittled away, then we still have enough kind of backup hours, right? I would really, the flip side of that is that I would really hate to see somebody come in with 755 hours and that travel time is included in those hours, right?
Hmm. Yeah, a
Yeah.
little too close for comfort there.
Oh, yeah. And to the point where I would say, look, we can try, but I think our chances here are not very good.
Right. So here's an interesting one, and this might help spell it out a little bit more for some folks. Let's say you're a teacher, so W-2 job, but you have summers off. So over the summers, you're in the property, you're fixing it up, you're doing all that and putting in the hours, and you're logging, the 750 hours by swinging the hammer all summer, and maybe, driving around trying to find, your second deal for the summer or something like that. Um,
Uh-huh.
how does that look? If you're out there in the property working, does that count?
Well, it certainly counts towards the 750-hour requirement, right? And then what I would absolutely do is if you have more than one rental, group them together, right? So that way all of the time spent across all these rentals would be geared towards meeting that 750-hour requirement. But you still have that first flaming hoop that you have to jump through, which is that more than half of your time needs to be spent as that real estate professional. So you would have to actually count up all of the hours that you spend with these real estate trade and businesses, and then also all of the hours that you spend in the school, being a teacher. And I suppose that would even include, the time after school where you're, cleaning chalkboards, you're grading papers, you're, doing the rest that goes along with being a teacher. You'd have to add up all those hours, and then as long as you're spending more than half your time as that real estate professional, then you should meet it. What I would say from a litigation standpoint, though, is that you're probably going to have to somehow prove how much time you spent as a teacher to then show that you spent more than half your time as a real estate professional. So, just the amount of legwork there is absolutely daunting.
Yeah, so in that case, you're logging not just your real estate hours, but you're logging your teacher hours, if you will, to further document, not just the classroom time, but all that extracurricular time that you might be putting in, and then you'd have to have the real estate be more than half.
Yeah, exactly, exactly. And that's, right off the bat, no matter how much real estate investing I do, I know for a fact that I will never be a real estate professional because I put in too much time as an attorney. There's just no way. So, I mean, and not only do I have to do the job itself, but then also I'm going to have to log everything. And then,
Hmm.
like I was saying, when you then go to the IRS and you litigate this or you try to settle it, hours get whittled away, and and what you think your logs show, and then what actually goes to settlement or court can be very different. So.
Hmm. Gotcha. So besides offsetting W-2 or 1099 income, what are the other advantages of the designation of real estate professional?
Yeah, really, it's the biggest one is, and really the opportunity that I look for and recommend it for is just being able to offset that normal income. That's really going to be the huge advantage and what you're going to want to be looking at.
Gotcha. And again, that's only if you're having losses. I mean, if you're, however you're writing things off, being profitable in your real estate endeavors, then that doesn't necessarily help you either.
It doesn't, and that's where tax planning really does come into effect, and the advantage of it, because it may be time to start looking at putting money back into the property, doing some improvements, getting some depreciation on there, because if we can start to generate kind of these, like I was saying, kind of these paper losses, you may cash flow in year 2, 3, whatever after you put in these depreciable assets. But you're still going to have deductions in those years following, because you're taking that depreciation over time, right?
Yeah. So here's a question. What's the difference between real estate professional and a real estate dealer?
Well, real real estate dealer. Sorry, I dropped my pen. That's kind of why the hesitation there. Real estate dealer is going to be one of those real estate trade or businesses that you can count towards the hourly requirement. A real estate professional is kind of the individual who jumps through hoops 1 and 2, right? The one who spends more than half their time in these real property trader businesses, which could be a dealer, and then more than 750 hours maybe in that dealer activity. So I would say real estate professional, kind of as I'm using it, is really a tax designation. It really is limited to those individuals who meet those, kind of jump through those first two hoops. Real estate dealer is one of the activities that you can engage in to get to that tax status, if that kind of makes sense.
Okay. I think we're wrapping up with some the questions here, and so we are now just I think 2 minutes over our 3 minutes over our 1 hour time here. Some people are logging off here. If anybody else has to, we are recording. As far as I know, we're recording this. So, and if so, we'll be putting it up on the Pine Financial YouTube page. So keep an eye out for that. Wanted to jump over and talk about that Investor Success Summit one last time. If you are in Denver and you're interested in it, you can find out more information and register at www.denveriss.com. Again, denveriss.com is in Denver Investor Success Summit. Let's see, I think there's a couple more questions here. Peter, where'd they go? So slightly different question here. Oh, where'd it go? This question came actually pretty early on. I recall reading something on accounting methods must be chosen by April of 2016. Can you elaborate? Or was that 2015?
Well, accounting methods can mean a few different things. There's a new form. It came out maybe, gosh, when did that come out? I think it was last year, 3116, I think it is. And it allows you to choose and change whether something's going to be considered an improvement or an improvement or a fixture, I think. And, you know, really this is getting much more in an area where Stephanie Long would be a good resource to talk to. But yeah, you know, given that your return is going to be due April 18th, I would imagine then that, you know, electing an accounting method or even changing your accounting method, it would make sense for that to line up with when the tax return would be due.
Gotcha, gotcha. So that kind of goes along with the repairs and maintenance. You know, when can I, you know, take the hit on these things, either in this year, or does it have to be capitalized over several years?
That's exactly it. Yeah, can you just expense it in that 1 year, or are you going to have to capitalize it over, you know, 28 years, 15 years, whatever it may be?
Right, okay. Gotcha.
Yeah. And it actually even allows you to change that. Sorry. So, you know, if you're stuck in a scenario where you're capitalizing it over 15 years, you could file that form and change, you know, basically take it that year.
Gotcha.
Yeah.
So seems like a similar question, but is the main advantage of claiming real estate pro status with the IRS that you can claim passive losses on your personal income tax?
Right, right. So, yeah, you'll claim the passive loss. It'll be on your 1040, but the main advantage is that going back to that kind of slide, the really crazy one I had with the buckets and everything, you know, what you're doing is essentially being able to take those passive losses and then offset the normal bucket of income. So you have your normal income. Normally you wouldn't be able to take the loss to offset that, but if you're a real estate professional, you can use that passive loss to offset that normal income.
Gotcha. Well, I think we've covered about everything, all the questions here. If anybody has any other questions, if we missed something, if I skipped over you, you're looking right there at Peter McFarland's contact information. If you want to get a hold of me, Justin Cooper, or Pine Financial Group, if you're looking for a hard money loan, my office number is 303-835-4445. My email address is justin@Pine Financial Group, and I think we've made it all the way through. So Peter, thank you for your time. Thank you for sharing all this information. There's a ton of information, a lot of great questions. I'm sure you're going to get a lot more questions in the next day or five. But thank you very much for spending your night with us.
No, it's absolutely my pleasure. Thank you very much, Justin.
All right, take care, Peter. We'll see you soon.
You too.